Hello, everybody. Welcome to another Tuesday 2-minute-ish tip at 2 o'clock. So today, what I want to talk about is buy downs, and then specifically, we're going to talk about temporary buy downs. There's two different types of buy downs. There's permanent buy downs, temporary buy downs. Today, I want to talk about temporary buy downs, how they work, how they're designed. A lot of confusion about them right now, and I get asked a lot of questions about them. So I just wanted to kind of spend a couple minutes discussing them, how they work, why they're a good tool to use in the specific environment we're in. So all buy downs are, they can be done with any type of loan, conventional, FHA, VA, you name it. It's just a way to help ease the burden of payments and is designed to help someone get into a house when we're in a higher interest rate environment like we're in right now. It's not something that lasts forever. And so I'm going to go through a couple of things with that we can do. So what I want to do here is I'm going to share my screen so we can take a look at that and see exactly how these work for us. So what I did here is these are just strictly for educational purposes, everyone. So I took a purchase price of $400,000, and in this situation, the borrower's putting 5% down. So they're putting $20,000 down payment. Our loan amount is going to be $380,000. So right here, this shows the different types of concessions that you can get on different types of loan programs. So if you're doing a conventional loan, and putting less than 10% down, the maximum seller concessions that can be contributed are 3%. If you're putting 10 to 25% down, conventional loans allow the seller to contribute up to 6% of the sales price. And then finally, if you're putting 25% down or more, the conventional loan programs, Fannie Mae and Freddie Mac, will allow the sellers to put as much as 9% seller concessions towards closing costs, buying down the interest rate, etc. Then FHA, doesn't matter how much you're putting down, you have to put at least 3.5% down, 6%. And then finally, VA, they will allow 4% seller concessions. However, with VA, there's a definition of what seller concessions are. That's a completely different video that I'll be doing some other time with that. So what I want to do here, again, this is just for educational purposes. This is not a rate quote. Everybody's different, but I just wanted to show an idea. So you have a few different buy downs that we can walk through here. We have what's called a 1-0 buy down, where for 1 year, it buys the interest rate down a whole percentage point lower to 6.25% in this scenario. The note rate payment is going to be $25.92 and 27 cents. The buy down payment's $23.39 and 73 cents. So you have a monthly savings of $252.54. So what happens is that monthly savings is multiplied by 12 months, and that's how we come up with the number 3,030.53. So in that scenario, for this purchase price, if they were doing a 1-0 buy down, the seller would have to contribute 0.758% to be applied to that for that buy down. Okay, now here's what's called a 1-1 buy down. So same thing, it's buying it down 1 percentage point for the first year, but the second year remains the same. So same thing in this scenario, our total savings for that ends up being $6,061. So the seller would have to contribute 1.515%. Then the most common one we hear about, and what's kind of the most popular and that makes sense, is what's called a 2-1 buy down. So what that means is, so the first year, this interest rate is going to be a whole 2 percentage points lower than what the note rate is. So year one, for an entire 12 months, the note rate would be 5.25%. And then for another 12 months, it would be 6.25%. And then finally, after 24 months, on month 25, it would go to the current note rate that was locked in at 7.25%. That's as high as it can go. Now, why does it make sense to do this? One, it helps ease the burden of a lower cost. And it's also a great product when you can foresee interest rates coming down in the near future. So right now, as soon as the Fed starts getting its thumb on inflation, what they're starting to do, you're going to see interest rates come down. Now, a couple questions about this. Can the borrower refinance at any time? Absolutely. So if year one is coming up and we're doing, let's say, a 2-1 buy down and they're at 5.25%, in year two, it's going to go to 6.25%. But instead of going to 6.25%, rates are now at, say, 5.75, 5.5 and a half, something like that. Absolutely. They can do a regular refinance into that. There's no prepayment penalties, are not going to be penalized, et cetera, et cetera. Especially if they're doing like an FHA or a VA loan, they can do a streamline refinance with that. You do not have to have 20% equity. You don't have to have a percentage equity. This is just a normal loan program. So if you're doing an FHA loan, conventional loan, whatever it is, it's just a normal buy down. That savings is just going into, think of it as like a separate escrow account. The same thing if you had a escrow account for your taxes and insurance, that money is just being put aside to make those extra payments on that from the seller. So that's how a 2-1 buy down works, or how any type of temporary buy down works in that scenario. So I ran a little bit longer today in my 2-minute ish, but this is something that's come up a lot lately. I've got a lot of questions about it, a lot of misunderstandings about it. So I just wanted to make a quick video to make sure that we put that information out there. Guys, give me a like or a comment below. Feel free to share this with anybody. If you have any questions about it, feel free to reach out. You can send me a message. Happy to chat. Other than that, everybody have an awesome day. Happy Tuesday to you. Talk to you later.